everyone, and welcome to the Buck Stops here. I'm Catherine Murray. Well, we have certainly seen such decimation within the tech sector in 2022. We've just received a number of the earnings calls and earnings results, which maybe are better than feared, but there's a lot of question marks in terms of whether or not now is the time to get back into some of these tech stocks, which were down by about 30% easily in 2022, and whether or not some of the rallies that we've seen thus far in 2023 are in fact sustainable. So who better to get perspective from than Dan Ives, somebody I've been interviewing for many, many years, managing director over at Wedbush Securities, covering about 35 tech names. Dan, thanks so much for joining us and giving us your perspective today on what to do in this very confusing market, particularly with respect to tech.
Yeah, and it's great to be here and talk to you. Look, as me and you talked for many, many years, it's an uncertain environment, but we believe tech stocks way overcorrected in 2022. And also, if you look, earnings season's been better than feared. I mean, these companies ripped the Band-Aid off, cut numbers, and I think stocks are as underowned as I've seen since 2009. And now a soft landing went from a 5% chance to probably a 60% chance plus. That's why I think tech stocks are up so much so far this year.
Right. And it's interesting, though, because to your point, better than feared, but some of the commentary from the company managements, and I guess this is where I'm confused in terms of how bullish or aggressive I want to be within tech. I mean, they were pretty cautionary comments, whether it was the consumer is slowing down, cloud businesses are slowing down, the ad business is slowing down, everything across the big bellwethers like Apple, Google, Amazon, Microsoft was really to the downside as it relates to the outlook for 2023. So it's hard to get excited, I think.
Yeah, look, I hear you. But I think slowing down, it's important to understand really what the growth looks like. I mean, I think in tech, especially in certain sectors, cloud, enterprise, cybersecurity, artificial intelligence, you still have 35-40% type of growth. You have a much more of a spending slowdown in digital advertising and some other areas. But I think if you look, demand on the consumer and enterprise is holding up pretty well. And I think it's also what's reflected in these tech stocks. I think a lot of bad news reflected when you look at names like Microsoft, you look at names like Meta, names like Apple, and the cost cuts are happening. And that's important because cost cuts ultimately lay the groundwork for what I view as the next cycle.
Why is it, though, that they needed to have such cost cuts? I mean, the narrative in the marketplace is that they overhired during COVID. I don't know. I mean, I find that a little bit hard to believe that that's the reason. What really is going on as to why they need to cut costs so aggressively?
I think it's a combination. I think a lot of these tech firms were hiring like 1980s rock stars. They were spending money like that the last 5-6 years. And then pandemic, you saw pull forward demand. These companies hired like hypergrowth is going to continue. But ultimately, the clock struck midnight on hypergrowth. And now you're starting to see tech companies needing to adjust to a softer environment. And I think that's really why you're seeing, what I view as probably the biggest cost cuts we've seen for tech since 2009.
Okay. I do want to go through some of the names because there's so many names under your coverage, which is phenomenal, which is why I really wanted to get you on my program. And you're doing it from Penn Station. So thank you for making time for us. Let's take a look at Apple and Apple's results and how you view the stock right now.
I mean, I think Apple demand's holding up pretty resilient. iPhone, you have 250 million iPhones that have been upgraded in the last 4 years. China, there's share gains. In China, if you look, the shortages was clearly the culprit for the December shortfall, but now we're seeing a reacceleration. And that's similar to what we're seeing with Tesla as well, which is why those are two of our favorite names.
Okay. And with Apple as well, and we're going to pick it up on the other side of the break, it's interesting and amazing to me that they have an installed base of 2 billion users, just to put this in perspective.
It's a golden install base. It's why I view them as a rock of Gibraltar tech stock that can navigate really better than any other. And it's why also they're not laying off to the level we've seen other tech firms. That's why Cook continues to be a Hall of Fame CEO. the way he's navigated Apple.
Okay. We're going to take a quick break. When we come back, I do want to get your take on gross margins at Apple, because that was always an area of concern going back a number of years ago, but it's very strong. We'll be right back. Dan, I just want to pick it up on the gross margin point as it relates to Apple. And I say this in the sense that going back a number of years ago, the bears on Apple would say that Apple is just a tech hardware play and that the margins will continually come under pressure. And at the same time, what we've got today actually is 44% gross margins, which look very, very strong and really puts the bears to the side. But can you weigh in on this and how we should be thinking about it?
Yeah, Catherine, it's a great point. I mean, these are the best gross margins in a decade. It's because Apple more and more control the ecosystem from chips to software. And I think that's really a big part of the re-rating that we've seen in Apple.
And what about the valuation right now? I mean, it's really kind of always looked quite attractive, but give us some perspective on that. Like, should people be thinking about Apple if they don't own it and buy it today? Or if you do own it, maybe add? What's the view?
Apple's one of our top picks. I view it as it's a sum of the parts play in terms of the services business and the hardware. I think services worth 1.2 to 1.3 trillion combined with the hardware business. I think this is a stock ultimately that could be back to 3 trillion as we go into the next 12 to 18 months. And I think these downturns that we've seen, they're the opportunities to own high quality tech with Apple being front and center.
And what about the upgrade cycle? Is that something that will be a tailwind in 2023, or what's the timing of that?
Well, despite the macro, you have 250 million iPhones that haven't been upgraded in 4 years. And that upgrade cycle is going to continue to play. I think it's playing out in China. And it's ultimately why Apple is in a much stronger position than other traditional tech players. It's the upgrade cycle, it's the install base, especially going into iPhone 15, which will be coming out.
Okay. I always wonder, Dan, weigh in on this. How do you know and when do you need to upgrade your phone? I mean, if you're saying people haven't done it in 4 years, what's the catalyst to get you to upgrade?
I think it's when that battery disappears in 15 minutes. I mean, look, it's the battery technology has improved so much. There's many iPhone users that have just replaced batteries and haven't upgraded. But I think camera technology, and it's ultimately the chips. If you look at the M1, the M2 chip, fastest phone in the world, I think that's really been the game changer for why many upgrade, especially globally.
Okay. Let's shift focus here a little bit. And I should mention as well, your price here on Apple is 180.
180, and I think bull
Okay.
case right now is 200.
Okay. Let's take a look at Tesla as well. That's another stock that gets so much focus. What's the view there? There's been a lot of volatility, obviously.
A lot of volatility, but I think if you look at the price cuts with Model 3, Model Y, it stimulated demand. Demand right now is 2x production. And I think in EV, we're still in the early days of this playing out. And Tesla, the scale now is much more global in terms of what they built out in China as well as Berlin and Austin. And I think Tesla, in my opinion, is the most transformational stock along with Apple in the market. We continue to be extremely bullish on Tesla here despite the storm. And I think Musk is able to sort of navigate that better than any had feared. That's why the stock's up so much year to date.
And when you talk about the storm, what aspect of the storm? There's a few, but in particular, what I'm thinking about is some of the competition within EV and the price cuts.
Well, competition's increasing across the board. It's really an EV arms race that's playing out now globally. But then, of course, you have recessionary type environments, softer demand. But look, Tesla, in our opinion, in China, based on a survey where 3 of every 4 is looking to buy a Tesla. In the US, they own the market. Competition's coming from all angles, but that's also why they have to cut prices. But they could be able to do that at very strong margins. That continues to really be the focus.
How do you look at and make sense of the valuation of Tesla? How should we be thinking about that?
I think you have to view it as a disruptive technology name and not an automobile company. I think on disruptive multiple, and, I think this is ultimately a stock that could get back to that $1 trillion market cap relative to where the market is. I think many have underestimated Tesla and just viewing it as an automobile company. I view it much more of as a disruptive technology play, especially you look at those margins and what they're able to do.
Okay. And interestingly as well, I wonder how many of the money managers and hedge funds sold it. And I don't know, maybe they haven't come back in yet. We'll take a quick break and we'll be right back. Dan, I just want to get your take. As I mentioned in the previous segment, where are the institutions right now in owning Tesla?
They've underowned it. I think there's, many because of the Twitter situation, that was a clear distraction in terms of that Musk premium that ultimately became an albatross. But I think many came in 2003 underowning Tesla, worrying about competition, worrying did the demand story end. And now I think many have been caught blindsided. And I think it's a very sort of fork in the road name, Tesla. I think many tend to not understand it, but I think that's really been the opportunity for those that do understand it.
And when you say you look at this as disruptive technology, what is it exactly that gets you so excited to call it that, and therefore, it's almost like you just own it and you don't worry about the valuation so much.
Well, first of all, electric vehicles, I think it's the biggest transformation to the auto industry since the 1950s. You look at the battery technology, you look at what Tesla's established, but then also you look at the software services. Going, out over the next decade, full self-driving, these are really what transforms automobiles to technology. And look, that's the same path that GM is trying to go after in terms of their EV strategy, Ford as well. And I think Tesla's really paved the way.
And it's interesting as well. One of the headwinds for the stock, of course, was some people's view that Elon would be just so focused on Twitter, also selling of the shares, etc. That seems to be turning into a tailwind for 2023.
It has. I mean, look, Musk was the culprit. And we talked, I think 70% of the sell off was the Musk Twitter soap opera. But we've seen that now go more into the background. I think the most important thing is now that Twitter as a company, which I covered when it was public, that it's more break even, advertisers have returned back to the platform. No reason now that Musk is going to have to sell stock to fund the Twitter losses. That's really been one of the biggest overhang in terms of that spider web between Twitter and Tesla that's now started to dissipate.
Yeah. And that's something that will probably continue to get played out in the marketplace to the upside. There's so many stocks that you cover, which is so phenomenal. So I do want to get to a couple other. What is your view on Uber? They're going to be reporting this week.
I think Uber's a name that they finally have hit an inflection point in terms of growth and profitability. Profitable is the most important thing because you're seeing stability, you're seeing drivers return, driver shortage was the big issue. But now they've cut costs. They're able to do it profitably. EBITDA, I think they're going to beat this quarter. That's really the key to Uber. I view this as a ride sharing name that's really a disruptive technology player globally. That's why we're bullish on Uber, despite what's been a lot of speed bumps since the IPO. I think really started to turn the corner.
Okay. And when we look at big tech, Amazon, I think during their call, they did call out the consumer slowing down, Google on the ad revenue side slowing down. What name, and then let's, of course, look at Facebook as well. What names would you be buying today out of those three?
I think you buy Google because of the cloud piece, as well as what I view as digital ads and stock. And I think Meta is a name because they've cut back costs and you feel like numbers are now hittable and there's adults in the room. I think those are two that I'd focus on. And then, of course, Microsoft in terms of the best cloud play, in my opinion, in the market.
Okay, and what about Amazon?
Look, I think Amazon, I think the bottom's in my opinion. The cloud piece in terms of the re-rating is very important. You still could see some downside on some of the consumer side, but I think Jazzy's cutting costs, doing what he needs to do. And I think he's laying the groundwork for the next stage of growth in Amazon over the coming years.
Hmm. Okay. And just real brief here then on Microsoft as well. I mean, their quarter was disappointing.
I think disappointing, but better than feared would be the narrative. I think we're still seeing growth 30% plus in terms of cloud. It's still in the middle innings of moving to cloud within Redmond. And you look at that Chat GBT deal, Microsoft Artificial Intelligence, I think right now the best US play in tech on the AI front.
Okay. We're going to take a quick break. When we come back, we'll wrap up a couple other tech names. Dan, we've covered a lot of names today, and you're pretty positive. Well, you certainly are positive. We've talked about owning and buying Tesla, Uber, Apple, Microsoft. Those are a few great names for people to think about. But I have to ask you, what don't you like?
I think a lot of it is more legacy tech. I think the share givers are the names like Cisco's and Juniper. And I think what you're really seeing is the traditional hardware players, the NetApps and others. I think more and more the share gainers, it's going to be software. It's going to be the cloud players. It's going to be cybersecurity. I mean, Catherine, I'm a big believer in investing in the tech trends that are going to be defining the next 1, 2, 5 years. And I think I try to stay away from some of like the shared donor names that, I think are going to have a lot of difficulty over the coming years.
Okay. And just on the software side, another example that you like is Salesforce. And they had a difficult quarter as well.
A lot of difficulty, but it's similar as Microsoft. It's an install-based play. Activism starting to increase, more focus on cost. The valuation I find super interesting. And I think this is another good example, like high quality tech name you want to own for the long term to play the cloud. I think it's very easy in these types of markets to throw some of these names away. Salesforce is one that, I think the risk reward here is super attractive.
What about Snowflake? Do you cover Snowflake?
Yeah, Snowflake in terms like you talk about the innovators, that's where Snowflake sits. The data dogs and some of the other. I think these are companies where valuations clearly maybe got over their skis, but Snowflake's probably one of the most innovative technology players in the market, in my opinion. A disruptor that I think continues to be what's going to be leading the next wave in terms of where I see Snowflake.
And it is amazing. I mean, the stock rallied so significantly prior to tech declining so significantly that it's difficult when I look at Snowflake to know what price makes sense to buy it at. Is it a buy right
Well,
now?
Catherine, I think that's the quagmire for many investors here. The Zscalers, the Snowflakes, like these high multiple names. How do you buy them? What is the right value? And I think that's a big part about what's happened in the market here. We're digesting some of the macro, but I do believe these high growth names, I think they were way oversold, and now you're starting to see them course correct.
Yeah. And so let's just kind of wrap it there, Dan, as it relates to, I said in the previous segment, your 2023 outlook. Well, that is what we've been doing, but I think maybe more from a macro perspective, because there still are a lot of unknowns. And I think some of the tech rally's been discounting the US Federal Reserve pausing, and maybe that is what we heard the other week. But how do you put that into perspective in terms of, you're out there recommending these stocks and for institutional investors and hedge funds to like buy now. And you got to have a view of the Fed and where we're at.
Well, 2022, you couldn't fight the Fed, right? Huge hawk mode to fight inflation. But I think now, just given that we see inflation rolling off with all the numbers, Fed's in the ninth inning of rate hikes. And I think that's the important thing. In this game of high stakes poker, markets reading through the comments, and you got maybe one or two more 25 bid hikes, but then I think we're done. And that's why I think the risk on trade, the tech trade, starts to become more in vogue. Now, clearly, there's a macro you got to deal with, and there's wild cards geopolitical. But at the end of the day, the late stages of their hikes, and that's bullish for tech and risk assets.
Despite the fact that the jobs number is still so strong, there's, it's a dual mandate.
It is, and I think that's why that soft landing, which was maybe a 5% chance 6 months ago, is 65% chance. Now, could that continue to keep that inflation? Of course. Well, it comes down to many were bearish on tech for 12 years of a historic bull rally. They're going to be bearish on this. If they won the lotto, they'd be negative on paying half in taxes.
Right. All right. So now's the time to get back into tech, is what I'm hearing from you, Dan. That was great to go through all of those names and get some of the fundamentals behind us. So thank you for that.
Thanks for having me.
Thank you. And thanks everybody for watching. Stay tuned for more on the Buck Stops here. We'll see you soon.